I see people making knee-jerk reactions because they're in a real pinch where they sign up with MCA and they regret it later. Most of the time there's regret. You have to stick with a 13-week cash flow and know when you're going to come in short on capital, or know when you're going to come in short on liquidity or cash, and you need to be ahead of the curve at all times. So when you're going to be short, you better start, 2-3 months, 4 or 5, maybe 6 months. You need to be ahead of it and trying to get your best financing arrangement in place so that you can fund through that shortfall.
As an owner, sometimes things don't go your way, whether it be losing a customer, supply chain, or maybe even staffing issues. Any one of these can be a small hiccup and could be a big problem. In this episode, we talked to John Trendell, and we were able to focus on alternative banking financing. We took a deep dive into alternative financing options with John. We talk about asset-based lending, or ABL, as well as factoring. What's the difference between the two, and how each of them can be beneficial for different situations that you may be in. Hope you enjoy the episode, and this is the Cashflow Chronicles Open Forum.
Yeah, John, so thanks so much for joining us here in the Cashflow Chronicles Open Forum. I think what's helpful for many people understand, I commonly come across it, is the difference between factoring and asset-based lending. Now, my understanding is you've been in the lending marketplace for a long time, right?
Mm-hmm. Yes, almost 25 years.
Okay. So, and Brad, obviously being a commercial banker, I'm sure you see your fair amount of the variables between factoring versus lending, right?
So I do asset-based lending, but I think what John does, it's a little bit different than how our traditional bankers like to look at it. So I'm excited to kind of hear what John has to say and how different but similar our worlds are.
Yeah, I think that's a good delineation because it is commonplace when banks can kick businesses out of the bank due to the fact they may not cash flow, or that's probably something you can speak to. I think kick somebody out is an incorrect term, but...
No, I think you're correct. Hardest thing is if it doesn't cash flow for us, that's a leading indicator.
Okay.
If it doesn't cash flow, we can talk to John. If it's close enough, maybe John's world can take it over.
So John, walk me through that process when you start a conversation with a business. How does that typically go when you determine the right place to advise a company?
Yeah, I think it has a lot to do with where they're at in the business stage. That hit a bump in the road, a company that is not bankable because of lack of history? Are they a mature company that has some growth opportunity that their current cash flow doesn't support it, but collateral and assets after they've gotten this new business will support it? And so there's a lot of different areas in which we have to look at the situation.
So when you mention collateral, is there generally like a benchmark that a business would know before coming to speak with you, or perhaps the bank looks at it and the business is more like, hey, this company is good, they pay?
Yeah, so we have the ability to monitor accounts receivable, inventory, machinery, equipment, and real estate, and more importantly, accounts receivable a little bit differently than the average bank because we have done it for a while. We have operating systems and the people involved that are able to monitor collateral, AR, inventory collateral a lot more closely than your average bank. You have to have an operations team that's able to do verifications on accounts receivable, look at the accounts receivable documentation, the shipping materials, shipper, purchase order, proof of performance, and tie that into and make sure that that's all together properly in order to provide that financing. A bank is going to not, maybe they'll look at it through a field exam, but they won't look at it on a borrowing cert by borrowing certificate or advanced submission as we would.
Okay, has there ever been circumstances where you go through that auditor examination process where there are scenarios where you're like, hey, this isn't as what should be expected, let's say potential a fraudulent invoice or...
Yeah, you hit stuff where you'll see where a billing, they'll bill or generate an invoice prior to it being shipped. Yeah, that happens often. Typically, there's a reason for it. There could be deliberate, we'll call it deliberate manipulation of the collateral, deliberately trying to generate invoices before it's shipped or actually earned to satisfy some type of debt obligation, such as a vendor or payroll or something else. That does happen. You'll see a lot of controls on the AR where they're not, where they have like billing changes, and if the billing change doesn't happen with a short period of time, the lender will look at that as dilution, where the customer will say, no, that's not dilution because we didn't write it off. Well, it's a change in the invoice and we finance it. So during the post our financing, that to us is a dilutive action. When you get into inventory financing, they have to have the proper controls in place, a perpetual system. They have to be able to, you do some type of test count on the inventory during a field exam. You do a cost testing. You want to ask them how often are they updating their costing on the inventory, things like that, as well as a obsolete excess category to make sure that's something that's being actively sold or sold within the last 12.
So there's a lot of controls, and I think as a bank, in a more, you could say, distressed scenario where a traditional bank can't necessarily lend against them, is there ever circumstances where you come across a company and this is a whole new experience for them? They've never had to work with a asset-based lender.
Yes, often.
Okay.
And it's a learning curve, and we have to go through a lot of time and effort into trying to explain to one the benefits of a borrowing-based certificate or a factoring relationship, how you can now manage your cash flow a little bit better because you have the borrowing certificate and you understand flows based on your average AR turn, based on how much inventory you're buying, based on when your payroll and when other expenses are going out the door, and when you're generating sales based on your backlog and how you're going to generate those. So the discipline under an asset-based lending structure can benefit a business, but there's a learning curve there and they have to get through that.
Yeah, I think that's something that commonly come across working in the trade credit insurance world, where we can help ABLs fortify some of the concerns in AR. Talking about the difference between factoring and an asset-based loan, because sometimes an ABL doesn't make sense if factoring agreements, you don't have appropriate billing collateral, billing processes, and that factoring is just a quick influx of cash into a business.
Yeah, structurally, asset-based lending is done on typically a loan and security agreement, and then factoring a purchase agreement. So the lender is actually purchasing those receivables. As far as how it operationally works, and specifically, the borrower / company that's providing the invoices have to generate or give all that documentation over the factor. The factor would review it, just as I was explaining. I want to see the invoice, proof of performance, and purchase order, make sure that they're shipping it on time. We also may be doing some type of form of verification, either through a portal or calling or emails. So, but that can go back and forth to both an ABL agreement and a factoring agreement. But typically factoring is a shorter term relationship, even though I've seen factoring relationships go for an extended period of time. There is a simplicity in reporting. It typically costs a little bit more because there's more overhead involved on the lender side, that they have to go through all those functions in a little more, a little more scrutiny or a little more work. The other side of it is the financial wherewithal. So a factor may not provide monthly financial statements. A factor may not even get annual review or any type of CPA financial statement. That's the simplicity of a factoring that comes into play. So it's the auxiliary things that I think mean a lot. Additionally, factoring typically doesn't have other collateral category, financing collateral category.
Yeah, I think that makes sense. Sometimes I think I know there's two things within factoring. There's like a recourse and a non-recourse agreement. Would you mind explaining a little bit the difference between the two?
So a recourse agreement means that the factor, if the invoice hits a certain age or there's some other discrepancy, they can sell it back to the customer, sell it back to them, and they typically sell it back to them through replacing it through other invoices. So they'll, the factor will get another invoice to replace the old one that's obviously newer or within the structure of the factory. It's eligible. Non-recourse means that the factor buys the invoice, and at that point in time, they will collect out of it. It's most often used in a retail, a company that's providing retail products to a large retail seller, or like we'll say a Macy's to that degree, like a Target. Those are often most used there. We have a smaller provider of a product that needs the protection of a collection of a factor to collect the receivables for them, and it gives them a little more certainty. They don't have to buy it back, and the documentation is a little more cut and dry with a recourse factoring agreement. Sorry, non-recourse.
So when you started an ABL relationship with a customer, you kind of mentioned about process. Are you doing I'll call it a pre-loan audit before when you walk in to try to do an asset-based relationship with the customer, and what does that involve?
So in most cases, yeah, we'll do a field exam prior to during the underwriting process and prior to initialing the first advance. And that involves, obviously, depending on the collateral, but that's going to depend on AR roll forward. So we'll typically do 13-month roll forward. We'll roll forward the general ledger and or sales journals, cash receipt journals, credit memo journals. We'll roll forward the AR, and we'll then reconcile to the GL on a monthly basis for 13 months prior. We'll do an invoice sample where we'll look at the documentation. Again, purchase order, proof of performance, and the actual invoice, when the invoice was billed, when it was, when the service or item was shipped, and then, cash receipts. So we'll look at the remittances and see, hey, when did this cash come in? When was that invoice billed? And we'll kind of look at the AR turn and see if it matches the one that we had with the roll forward, because the roll forward will determine cash turn as well as sales turn and whatnot. Then if you get into inventory, as I explained, cost test, invoice test count, obsolete excess, and also a margin test. Make sure that when you're looking at the items that are being sold, that they match the margin that's on the income statement on a regular basis. And then we'll review taxes. We'll look at cash as far as where the bank account structures are. Make sure that that there's no significant disbursements. Taxes have to get paid, property taxes, your payroll taxes, all of that. And then typically a field exam we'll say a cursory review of the financial statements, but it won't be as in-depth as what the underwriter will use during the underwriting process.
That was going to be my next question. You did up front before you did the loan. How often are you doing that on a go-forward basis?
So depending on the credit, the cash flow, like we said, there's certain levels of cash flow. So when we're discussing the difference between, your lending and my lending, I appreciate storied credit. So someone hit a bump in the road, or someone's had, like a growth opportunity. We'll look at the current, the balance sheet structure, the leverage structure. We'll look at the financial performance, and then we'll determine, based on the initial field exam, how often we have to do a field exam. But I would say it's going to be somewhere between 1 and 4 annually.
Okay.
So somewhere in there, depending on all of those combined characteristics.
As someone outside of the banking sector, how about you, Brad? How frequently do you analyze those? Is it an annual basis, or is it?
Depends on the bank, right? So each bank is going to have its own credit policy. And based upon that policy, it may be it's at a particular dollar amount. We may require a borrowing base, we may not. Right? If it's $1 million, depending on the size of the bank may say that is a risky, we don't want to, or at $1 million, we're not going to worry about it. But it goes back to what John was saying was, at $1 million, is it a sophisticated customer or not? Do they understand their own processes and system? But as a bank, can you trust what they're giving you? So a lot of times if it's a larger one, yeah, we're going to do a pre-loan audit on it to make sure we understand. We're going to get an understanding of where the holes are or gaps are within their reporting and how we can adjust that. And at that point, we'll determine kind of an advance rate or an offset against it. Again, inventory, kind of the same thing. We'll do a test. We'll check it. But ideally, it depends on the bank. It depends on the size of what credit would allow and what not. Then may want to look at, in John's world where other banks may not want to touch. Whether, like he said, I think a good example, like he said, is you got a good operator, understands the process. They've been asked to leave by their bank because they had a hiccup. And that's where he can kind of come in and bridge the gap or get them back to performing.
So, and to Brad's point, when you determine like interest rates and like cost of different transactions, is that generally just based on the examination audit process, or is there a pretty standard rate you guys use?
Yeah, I would say that it is subjective, and it is going to be based on the collateral mix as well as the finance performance. and the need, the liquidity need, and where we're going to get.
Are there ever circumstances when like the delta between an asset-based loan versus a factoring is going to be a big difference?
I think getting into the factoring and the ease of use. Factoring typically does not require field.
Okay.
So field exams are an overhead cost that are significant. That not only the lender doesn't really count it as revenue. We don't count it into our yield and cost. Even if I have internal, I have to
100%. Yeah.
overhead. So that's where you get into a little bit of differences. The ease of use, because it is on a dollar by dollar basis. It'll be more expensive based on the cost of the dollar being borrowed or being used through the factoring agreement. But the other things, the third party costs, like reviewed financials with an ABL or some type of CPA provided financials. Field exams are required with an ABL, but they're not with a factor. So those things can create a factoring being more efficient and less cost.
I think that's a good delineation because yes, interest rates will be a little, or like the fees will be a little bit lower, but all in, the overall cost of the setup and structure, it can sometimes be an equal wash as far as the overall cost goes. That's a really good point.
Yeah,
up.
Typically transactions under $1 million, let's say under 750, you start to get into the economics of third party where it doesn't make an ABL, and sometimes it does, sometimes it doesn't. It depends on where your growth trajectory is going to be and your usage, and where you want to be, within the next year or two.
I think it's important having somebody that can pursue both options versus this is the only thing we do. Hey, it might make sense to shift this way or the other way. I think this was a recent conversation. Someone had an ABL agreement and they fell back into a factoring agreement due to something that fell through. So this is our next step. Has that ever happened to you in the past?
Yeah, we have seen where, let's say there is a deterioration in the financial record and we need to monitor the collateral more accounts receivable. We will pivot and put it into type situation. We also have what we call a ledgered line product where we monitor accounts receivable. We mirror the accounts receivable aging. We monitor very closely, but it is on a loan and security agreement. So it acts like a factoring agreement. It's a loan and security where you have interest versus the factoring agreement purchase.
Okay, that makes a lot of sense. I think the one question is always, if you come into a business and you walk through these different options, would you say most executives are familiar with the depth of like underwriting and the education process?
It goes back to that same question you asked. How many people have you ever had someone that hasn't had, an ABL agreement in place yet? It's where they're at in the business cycle and the maturity of the business. Most manufacturing facilities, especially in the Midwest here, have had ABLs.
Yeah.
Factoring, it depends on what industry you're in, and it does change from financier to financier how they interact with the client.
Yeah, and I think just a personalized service approach. Hey, this is what we recommend based on the underwriting that comes into play. So it's never this is the best option for you. Factoring is 1%, while an asset-based loan could be this or that. You need to go through a thorough analysis to go down both routes, or bring in an expert with the financial expertise to.
Yeah, and a lot of deals I see already have an advisor, and that advisor is a third-party advisor, and I highly recommend getting an advisor
Okay, and just for the audience, would you advise like how to get a third-party advisor, or is there would it be like a turnaround type individual, or would it be?
Yeah, there's a lot of debt advisories that help out, and they typically do turnaround as well.
Okay.
So it's hand in hand. Investment bankers will sometimes do a debt advisory as well to help someone with their capital stack. We'll call that fancy word. But yeah, I definitely think the advantage of having an advisor is that they're going to know the current land. If I refinanced 5 years ago the landscape, and that advisor is going to know the players that are currently active in the market, and their tolerance and pricing.
Yeah, they can shop the market from at least to give a benchmark as far as like this is what to expect.
Yeah, they've been shopping the market actively every day. That's something that they're in. It's fluid.
And I think that's a total relevant topic. So I had I presented to a group of credit managers this past week, and I was talking about merchant cash advances. What have you seen in that space of merchant cash advances? Because you get cash the next day, you can avoid all that underwriting.
Yeah, it's very expensive, and I think you have to really read that agreement and understand your costs. I mean, the same thing as factoring. You really have to, and all lending, you really have to look at what are your real costs. I see people making knee-jerk reactions because they're in a real pinch where they sign up with that and they regret it later. Most of the time, it's new business. You have to be proactive. You have to stick with a 13-week cash flow and know when you're going to come in short on capital, or know when you're going to come in short on liquidity or cash, and you need to be ahead of the curve at all times. So when you're going to be short, you better start 2-3 months, 4 or 5, maybe 6 months. You need to be ahead of it and trying to get your best financing arrangement in place so that you can fund through that shortfall.
So I track bankruptcies on a daily basis, and the amount of MCAs I see on bankruptcies just because AR is 90 days late and they got to make payroll, they got to make their operational expenses, and you see them file 6 months after that agreement comes into place. It's very unfortunate.
I think once you get into one of those, it's hard to get out.
You stack them.
Right. So you have to, it's just every day you get money coming in, and guess what? If you're trying to get out of it, it's cash advance loans. It's kind of what the same feel as what those.
Yeah, and lenders frown on them in general.
Yeah.
If you currently have a client in your portfolio and they're getting them, you're not very happy.
That's a
because
flag.
It's a huge flag. If you have MCAs and you're onboarding someone who has a lot of flag, especially if you're not able to with the initial.
Well, a common theme when this whole cash flow chronicles first started was a 13-week cash flow. That's just the foundation to a business. And it's interesting how many businesses don't have that consistency and the dedication.
Right.
Is that something you guys see quite a bit when you guys look at financials?
I'll ask, hey, can you give me projections? And sometimes that's tough, right? So they do have a plan, they have a roadmap, but being very conservative with a 13-week cash flow for them may be tough. They either haven't gone through the exercise, or they may not have the wherewithal to do it, right? Maybe they're just using a fractional CFO, but that fractional CFO may just be using, just doing the month-end closing of the statements. They're not doing the day-to-day projections or the finance and processing of the receivables and payables.
And I guess from you too, obviously there's a lot of companies facing some obstacles at the moment. Have you seen a lot of that as part of your job to get them to build that process out when you do loan?
Yeah, and that goes back into the financial advisor and debt advisor.
Yeah.
that they're usually providing it, but I'll
Okay.
typically ask for it. I mean, we have a spreadsheet. We do it and try and plug in, and
Of
we've
course.
done it with someone that's currently in the portfolio. But it typically doesn't happen until there's an urgent need or someone's absolutely requiring it, especially on someone, again, the maturity level of a bit. Most businesses have done it one time or another if they've been around a while, until they do.
Yeah.
And then when they do, then
They understand, we got to get this in order because we're facing some potential. We got to prioritize this area. And then we're facing a downturn, or so be it. So from both of your standpoints in the lending, are there any industries that you're seeing that are facing some more challenges? Obviously, automotive has been going through its fair share of challenges. Is there any other industry in the Motor City that you guys are seeing that is coming across some hard
Automotive's
times?
probably top of mind, right? It's automotive partners, OEMs coming in saying, dear partner, give us 2-3% cutbacks, but volumes have come back. The OEMs will look to stretch you, and they'll look to their supplier base to stretch them from 90 to 120, 120 to 150, 150, 180. That's hard to do as a small business. Tier 1, okay, but tier 2 and 3 suppliers, that's tough to do. If they're not getting paid, they can't make payroll. And then as a bank, as traditional banking, 90 days sometimes. And now I'm going to have to go back and carve out an extra piece, 90 to 120, 120, 150 of that particular receivable. Again, and it's how is a bank going to get comfortable with those receivables? But automotive, yeah, we're seeing stretched receivables from that aspect.
And then I'm assuming then you have to maybe politely kick them out.
Or pull it back. So we'll give you what we'll call an over limit for a portion. Call it 6 months, 3 months, whatever it may be. But at that time, hopefully it comes down. If it doesn't, now we're asking for more time again. So now that either cap goes up or they need another 3-6 months with that extended receivable.
And ideally, you want to keep them in the bank as much as you can. And
They're the
and
best people to collect their own receipt, right? You can attest to that. And
Yes.
it's really funny. So having worked in special assets, the workout world of the bank, that was it was kind of surprising when a customer came to me and said, "Oh, thank God you're extending my credit again." And I was kind of surprised when I first saw that, because I'm like, well, why would we want to put you out of business? You're the best person to collect all your receivables, and that's what we're relying upon to repay the loans.
And then obviously, when it comes to you, John, after a bank went through all its proper protocols, is it on a case-by-case basis, as you mentioned?
Yeah, I mean, there has to be a story, like what happened that caused the financial deficiency, downfall, total down bump.
Yeah.
And then what are you doing to correct it, or what have you done to correct it? And we typically like to see a month, or start to see proactive action result.
Yeah, and I think we talk about kicking out of the bank. It's not a negative thing. It's just, you talk about, it's just a bump. Like, we're facing uncertain times. We need something to help us navigate these uncertain times short term. So
we kind of talked about it just before we turned on the cameras, was the relationship base to it. So if you have, it's important to have a good banker that understands the relationship, right? You build trust, you take the time to learn who your banker is, but you have to understand, at the first sign of weakness, is that banker going to be able to help you? Is that bank going to be able to help you? At any point in time, a bank can easily come in and say, you know what, no more of X industry, and they just exit. And that's not fair to the customer. But again, you never know when that'll happen. And I think it's important that relationships are important, and you got to build trust with that person, with that bank. And it's unfortunate, but yeah, at times a bank may just exit a relationship completely just because either it's the industry, or, hey, we saw this, we don't like it, good luck to you, go find another bank.
yeah, I think the character piece that John mentioned, hey, is this a good business? Do they have a good foundation of how to get out of their current downturn? So what do you want the listeners to know, John, and how can we help you as a general community as far as closing in on this conversation we're having?
I think everyone should act sooner rather than later. If you see a illiquidity event occurring, get your current lender on the phone, get an advisor, communicate, and start to be proactive right away. You're better off being proactive than you are being reactive. At least be prepared. You may not have to take action, prepared, so that you're not left sitting there. I would say this, in general, most lenders, banks, your traditional lenders, are being a lot more lenient, pushing people out. But it's the events where you need the extra liquidity or extra access to capital because you have a growth opportunity or a new opportunity come in, or a switch in your business, where you have to have the proper lender in place in order to facilitate that. And you need to act accordingly and get that ahead of time.
That's great insight, because that's where partnerships come into play. I want to understand your business. I'm proactive as a partner versus just a lender. That's really good insights. So I appreciate your time, John.
Thank you.
Thank you, everyone.
Thanks.